Today, I feel we are in wave 2 of Elliott's cycle. And when I say wave 2, that means we're still in a very large position in a bull market, and we're just taking a temporary pause in this entire structure. The Elliott wave cycle explains to us that in a bull market, that you don't climb up in a straight line. In fact, in a bull market, you have 5 waves moving up. Wave 1, wave 2, wave 3, wave 4, wave 5. And that's how bull markets come to be able to express themselves. I feel we're here. I hope that doesn't sadden you. I thought that should. This tries to be able to explain to you that markets have gone through round number 1. And round number 1 exaggerated itself into the top end of it, and we're getting a profit-taking condition that will allow companies to become more attractive for you once again. They've made good money. They're going to be reinvesting these back into their respective economies and industries, and that should be able to generate more income for the companies moving forward. And so you still have quite a bit of waves to be able to experience. Remember, this takes years to be able to flow through. And so you will get a generally corresponding movement that will be taking place later on. Now, wave 2 inside Elliott's cycle tells you that although you are making a corrective wave like this, it will not, or rather it should not, fall below what we call a 61.8% retracement of this entire first swing. So the maximum, at the maximum decline, it should be a pullback of about 61.8%. In what I've seen in my history, it doesn't even go close to that values when we usually see the wave 2 level. Maybe a 38% or 50% is usually what is normal. But I'm just telling you what, of course, Elliott says, it should not go back down to that particular zone. And thereafter, that you should expect prices to be able to do that. However, wave 2 is actually a process of 3 waves on the way down. It's like something like this also. Your corrective wave in wave 2 is a smaller version of an ABC on the way down. And if you want to ask me where I think we are in the corrective wave, I think we're here. We're in the C wave. And that means I really feel that we are around the corner to be able to see expressive lows that will give you the ability to buy prices at much more decent levels. And I don't think that's going to be too far off. All right, so let's try to be able to discuss what then lies ahead. And what lies ahead for markets right now is, I think we will still show some diverging movements in markets. I think that's very clear. Some of the more mature markets are going up. They're quite overbought right now, but countries like ours are not overbought. And so there could eventually be that particular shift back into more attractive investments. So corrections in Southeast Asia are temporary. I feel that much of this movement was a prodding of pullbacks to be able to engage them out of those overbought conditions and allow you to be able to make risk-reward options much better for people. The Philippine reaction is not isolated. That means don't think that we're only moving alone. I've shown you several other markets that also are doing the same thing. So I do not think it's a structural problem of the Philippines. This is just a phase that we would go through because we went much further than everybody else on round number 1. And several months of overbought levels is what's being unwound right now. And as this attempt to be able to flow up, and that's why we're seeing some downtrending channels, and they're usually longer than what we've seen the last 2 years, it's really clearly an ability for that. And of course, the capital raising exercises we've also seen in the short term have sapped the momentum of markets. And until these things start to bear fruit by showing better potential earnings, I think companies will try to be able to mellow off, but only into the short term. So our job is really to be able to wait for such signals to be able to move back in. Where indices are already falling to major support levels, so it's time for us to start watching markets in the short term, see if prices can start to level off, and we see that activity, we should start preparing, of course, our investment or trading strategies accordingly. So this is a weekly graph of the Philippine index, and you can see as of yesterday, our index have exactly gone back down to the trend line level. And to be exact, that's closer to about 3,830 to about the 3,800 level zone. So this is roughly our first level of support. Now, just in case that particular support level happens to break, there could be a little bit more downside. And as agreement with April, perhaps in terms of maximum, it would be between 3,640 to 3,400. And I'm not really keen on seeing that 3,400. I think it'd probably be higher, right? And resistance will still be very much on the previous highs, but I'm sure this consolidation area will prove to be quite resistant in the short term. And it's because of that I would expect markets to be able to lock itself first into in an area pattern. This is a daily graph of that same index. And if you look at the daily graph, this is the area pattern we're currently involved in. We can see a declining channel into the short term, and prices are pulling back down. And right now we're trying to see whether, of course, this 3,800 can try to hold. And the one-year moving average is standing closer to that 3,640 level, which is this next level of support. So I'm currently watching those, at least that boundary, to be able to see where we can get a opportunistic bounce for us to be able to move in. Now, channels take time to unravel. And so if you can see what I've drawn over here is this consolidation breakdown is like this consolidation breakdown taking place over here. And this could be quite descriptive of what your market will look like. It's going to be a bit choppy, like I said, and that type of movement takes time to turn around. So you'd see rebounds and a pullback again. And what we're waiting for is for prices to be able to level sideways or maybe make a higher low, and that should be able to give us good enough prompt to be able to move our money back into stocks that are showing similar types of formations. All right, so my expected scenario is that, at least for the first bounce, that we should see some degree of demand come closer to the 3.8 or 3.640 level. That is my support window, so I'll be watching my radar of degree of stocks to be able to look for potential turnarounds from that point on. If these rebounds actually manage to happen right away, expect these guys to be able to give you a range trading opportunity. But don't expect this to go back all the way up to the index level right away. What will happen is it will climb back to the next resistance and bounce back down and try to be able to level off before engaging back into a solid uptrending move. So expect box-like or channel formations to exist into the short term. But hopefully by the second half of 2011, things could change. So we really are waiting for this. Double lows and higher lows to be able to manifest, to be able to trigger a buy conditions. And once we see that, the ability for prices to be able to make a much more solid recovery will be there. Every time prices come back down and they make lower lows, then it'll be still very difficult for prices to be able to make an adjustment upward. So we have to be a little bit careful about what we're going to be picking. So at least for the first half, although I think that there will be already a recovery, perhaps towards the second quarter of the year, I don't think that you're going to see it all the way back up to the index level that quickly. So it'll take time to unwind itself and eventually turn itself up. I'm expecting that towards the second half of the year. Okay, so this is what we want to be able to wait for and what technical perspective we should have for some strategies in our stock picking. We want to be able to look for pullbacks to major support, preferably for stocks that have only pulled back perhaps to the 65-day moving average or the 130-day moving average. Now, my preference is to big companies that are in this level because the ability for them to rebound is usually a little bit stronger. However, if your index shows this and that you can see that some of your prices or your stocks fall below their 130-day moving average, then expect sideways markets first to exist in those types of circumstances. So maybe I could pull up Banco de Oro here as an example. Banco de Oro has just fallen. This is the 130-day moving average, and it's now fallen to its one-year moving average. And that 260-day moving average should try to be able to profess some levels of support and hopefully can create another bounce. But what I said, you're going to get a box-like pattern, and what the prices are going to do is they could make a rebound choppily and try to use this, your 130-day moving average, as your new resistance zone. So it'll lock itself up in that area for a while. And then after it can break up above that resistance, and here we go, happy days are back again. But until that day comes in, you have to be able to watch out for opportunities that look stronger, not weaker. Right? Look for stronger opportunities, and don't say just because it fell deeper automatically that it will climb faster. That's not the case. Try to be able to measure out by, of course, technically stronger conditions. Now we'll look for horizontal basis. So this is what I mean by a double test of support. Prices are making lower lows. What we want to see is a rally, a pullback, staying flat back at this level and recovering again. This should be able to produce a much wider rally for you. Or if you could get a higher low, trend line break, and sponsoring a new breakout from formations like this is even better. And that can generate much more advances in the short term than, of course, the first one. And that will create much more solid ground for your opportunity. Now, it is preferred, however, that before you start buying, that short-term moving averages are breaking, because that will give you a qualified bet that at least some people are starting to make money again, and that can create much more impact into the level of choices that you're doing, and the upsides automatically are very much pronounced. But if you're only buying it as soon as those rebounds take place, more likely to rebound to shorter-term moving averages, and will stay there for a while before breakouts. They might create little patterns like this first. So don't let that scare you. Just understand that they need to do that before they continue to move. All right, so I'd like to be able to talk a little bit about some of the picks that April showed you earlier on, and just to be able to show you the state of affairs in each one of them technically. And as she's mentioned up inside her particular list, if you notice, quite a few of the banks and the properties are still very much into a short-term downtrend. And you know how I feel about that. Until those things start to rectify themselves, you're going to have to be very, very careful if you're using short-term money to engage in those stocks, because there could be still some downward action, maybe a little bit more, but it doesn't look like it's still quite timely to be able to participate in this set, because trends are still maintaining downwards. Moreover, what I did here on the right side is I indicated what the 130-day moving average is. So if you notice that the color is color red, that means prices today are lower than the 130-day moving average, and that means that most likely these companies will have to go through a consolidation first before they make a substantial rebound. Okay? The ones below that, like Alliance Global, DM Consunji, Semirara, Nickel Asia, Energy Development, and ICTSI, although some of them were between sideways and uptrends, these guys have not broken below their 130-day moving average, and they still show the capacity to be able to make good recoveries, even if you're looking to be able to buy them into the short term. So I really have no problem looking for range trades there, or the ability to buy some of those uptrends in pullbacks. That should still be the case right now. In terms of levels of support, you can clearly see that I've identified 2 levels of the existing support areas. If somehow prices can come closer to those areas, those particular price points will make your risk levels very much low, and it might provide good opportunities for those who are trying to bargain hunt. At least if you're trying to bargain hunt, even in a downtrend, let's try to make sure that you're bargain hunting closer to decent levels that can sustain themselves, rather than things that are not too ripe just yet. So I clearly feel confident that many of these stocks, if not all of them, can still continue to be able to push out. We're just waiting for the top half to be able to show you a much clearer technical standing, although the lower half inside that list still look good for placement into the short term, so don't keep your eye off them. You will still see short-term opportunities to make money in those particular stocks. All right, so in summary, I guess with what I was saying, markets are still very much into an uptrend, and that's quite clear for me. We're seeing conditions right now that are still quite malleable to be able to keep us on that upward peg. We're just going through a correction for the meantime. And markets have managed to be able to show uneven strides, because like I said, fund managers seem to have a very different condition right now, and they're doing things into the medium term rather than orchestrating these things one by one in their own condition. And this is why, of course, we've had that. And some headwinds will still continue to be able to reason out corrective movements. But like I said, please don't be afraid. Use these corrections as your opportunity to be able to look at prices so that you can buy them at much more decent levels, because we weren't given that opportunity 1-2 years ago. And like I said, I feel that we are in Elliott's wave number 2, and this is just the bull market beginning. And that means that there will still be considerable upside that you can come off into this later on. We just have to wait for wave 2 to be able to clean itself up and allow new investor blood to come back in and take prices and create these necessary lows that can justify short-term entries into these particular movements.